It's that time again. It's the April look back for the 2012 market update. What's up and down with housing and lending? So let's start out with some of the key highlights. U.S. economy continues to improve, but slowing. We're going to call that neutral. Jobs continue to improve, and that has been one of the key positives. Savings continuing to flatten out about 4.6% last month. That is still sort of neutral in terms of overall savings rates. Inventory is flattening out, so that positive is becoming a bit more neutral as we're seeing more inventory hit the market. Valuations continue to decline, and that is still a negative. Overall, from a future standpoint, a bottom is forming, but weak, and 2011 will probably prove to be the floor, but we never know that the floor until we get out far enough from it to say and look back and say that was the bottom, that was the floor. Some markets are better than others, so real estate, again, is always local. Net legislation proposed is currently going to help push and accelerate short sales and foreclosures. So overall right now, we lost some recovery momentum, and this is going to take some time. So let's look at the details. Where are we now? I'd like to look at sort of the where are we now from the point of maximum financial risk compared to the point of maximum financial opportunity. From an asset side of the balance sheet, stocks, investments, etc., we see that loss of 13,000, the Dow, a lot of uncertainty over what's going on in Spain. We've moved from sort of thrill and euphoria here to a little bit more of a place of anxiety as people are starting to tighten up and get a little more worried about the current economy. Overall, when we look at housing, we're still pretty stable where we were, right around that place that we call hope. Some improvement, but overall, as the downward arrow starts to flatten out, things sort of become neutral. But again, that's a good sign. It's kind of like no bad news is good news. So we'll first take a quick look at the general market, then we'll move on down to the street level. So we saw in our last report there were only 2 of the 360 metro housing markets that had improved. But we can actually see here that over the last 2 quarters, 101 of the 360 metro markets have actually shown some pretty solid signs of improvement. So all real estate is local, and we're seeing certain markets really start to improve. Now, on our existing home sales, we saw a little bit of a slip. We adjusted to about 4.59 million annual units. That's about an 8.8% increase over this time last year, which is great news. Again, existing home sales continue to be strong, especially compared to new home sales. Now, we mentioned that inventory was getting sopped up a bit, and we kept seeing these declining inventories. We saw our first uptick as supply increased from that critical 6-month level back up to 6.4 months. This is important. Most of this is coming from new foreclosures hitting the market, as well as a slightly slower seasonal sales period at the beginning of the year. So what we'd hope to see here is that the inventory itself might tick up and then start to roll over. Remember, the 6 month line here is critical, as it tends to be a real benchmark. When inventories get below the 6% level, we see positive appreciation and positive home price values. When the inventory is above 6%, historically, we have seen prices of real estate see more pressure as people have to lower their prices to try to move those houses, and that continues to put pressure. So this is a critical number here. We want to see this inventory continue to move below that 6-month standpoint if we want to see house prices tick up. Real house prices, as we know, continue down again. So we're back to this sort of level here around 100, which is back in the late 80s. So and depending on whether you're looking at Case-Shiller or CoreLogic or the Case-Shiller Composite, at the end of the day, for most people, a house purchased in 1988 is worth about the same in real house price terms as it was in 1988. Now, this is inflation adjusted. You may have a $200,000 house that's now worth $300,000 and feel like you have $100,000 of increased wealth. But in reality, when you look at real house prices, which mean adjusted for inflation, we are actually back to 1988 price levels. Now, one positive for price values, and we're going to spend a little more time talking about an important part of this recovery, is people seeing the value of their home start to increase, either to be able to refinance or to transfer equity from that home to buy a new house, or simply to feel good about owning a home again. We can see here that what we're starting to see in all three areas, the 25th percentile, that would be your lower property percentile, your blue, which is your median, that's your average price, and then your green and above, this is your jumbo, this is your higher upper 75th percentile of property. And we've got our overall composite. You can see that in the Case-Shiller composite, the actual prices have been going down and they've stabilized. But what we're starting to see here is that people are asking more for their properties. Now, whether they get that or not, I don't know. The average asking price has gone up almost 4% over the last year, even as prices continue to go down. So that means that people are more optimistic about their chances of getting higher prices. So whether you look at distressed sales or exclude distressed sales, one of the things we're seeing is that year-over-year declines have started to decrease. We saw on average about a 2.5% decrease overall in this past year. Most everyone expects us to cross that zero line in the second quarter of this year, and we should start to trend up from there. Household real estate wealth. If you don't think it needs to be managed, look at the financial impact that it's had. Basically, from the peak here to the bottom here, we saw a $66.8 trillion real estate market drop to a $50 trillion real estate market. That's a $16.4 trillion loss. Just in the last quarter from here, we saw a $213 billion decline in real estate values at the consumer level. Just to think about that, right now in the U.S., there are about 74 million homeowners. 22 million have no mortgage debt at all. About 11 million have negative equity. So about 33 million, not quite half, either have one extreme of negative equity or the other extreme of having no current mortgage at all. That leaves about 44 million homeowners with a mix somewhere between 0 and 99% equity. Unemployment did continue to drop to about 353,000 unemployment claims. That number continues to drop, and that's critical as the job stability needs to be there for mortgage and rent payments to be made on time, for the housing to make its recovery. It's an interesting chart. Again, you've seen it before, but this is our baseline peak employment prior to our recession low, which was here 24 months after peak employment when we started our recession. We can now see that we've gotten back here. We can see on a relative basis how much more devastating this recession was from a job standpoint. We've added back about 3.17 million jobs since the bottom. There are about 5.2 million fewer private jobs now. And this is, again, a systemic thing. Many people don't believe we'll ever recover to the employment rates of yesteryear because companies have become more efficient working with fewer people, and they don't believe that they need to hire back the number of workers that they had in the past. You could say that the technology had done its job, but the people that were there putting that technology in place didn't want to be disintermediated. Now that they're out of the way and gone, that productivity lift has been there. That's why we see corporations having all-time record profits based on this much more efficient productivity. That'll leave more and more people starting up new businesses or finding new ways as they challenge or are challenged to find work in the new economy. When we look at total foreclosure sales as a percent of all sales, we can see that if we look at the number of foreclosure sales, that number peaked in 2009 at over 1 million sales. We've been moving down between 927 and 907. That's positive. And also as a percent of all sales, the column here on the right, it's now somewhere between 22-23% of all sales are foreclosure related. So another interesting thing is the total foreclosure sales from an average price standpoint have continued to drop, meaning that in 2006 an average foreclosure was around 224. Today, an average foreclosure is close to 164,349. The bad news is that the average discount has continued to go up. So you could say that, back here, the average discount on foreclosure was only around 22%. Right now, we're still running at over a 32 to 33% discount to the what you might call the current asking price of that property to liquidate it, and the average foreclosure price has dropped to that 164 level. One more look at just overall losses by type. Lenders on average right now are taking an average loss of $19,474 per property. Investors who purchase properties and own those properties are taking a very similar loss, and government agencies are taking a smaller loss at around $11,000. One of the other things that has been real evident in this particular process is that the high poverty, lower income tracts are taking a much higher discount, up to 60%, whereas the low poverty, higher income areas are taking traditionally a much lower percentage loss. Up until this year, in 2010, we saw that even the high income, low poverty tracts were having to be discounted. So we've seen that discounting continue to go up to sop up that excess inventory. We'd like to see that start to decrease as well for property prices to begin to stabilize. The average foreclosure rates of 90-plus day properties has decreased to 7.2%. So 7.2% of Americans are 90-plus days or in some phase of active foreclosure. That's down from 7.8, which is great. We see our serious delinquent sand states here in many cases, and this would include the places like California, Arizona, Louisiana, Florida, etc. But overall, we actually saw 32 of the top 100 markets still having some increase in foreclosure rates in this last quarter. So let's take a little bit closer look at the street level, how this is impacting the average consumer. How do consumers feel? That's what sentiment measures, because how they feel about the economy has an impact on their spending, their buying of homes, their borrowing, their using credit cards. And sentiment declined from 75.3 to 74.3 over this last period. Now we know that sentiment plays into many things. If you think house prices are going down from here, you're not going to buy new houses and home ownership rates will continue to decline. Or you'll move out of a house and you'll start renting because you believe that's the best thing for you. The HVS measurement is the blue line. The red dots are the census measurements of actual home ownership rates. The census comes in around 65%. The HVS studies are coming in right around 66%. But overall, as you can see, we've seen a peak of close to 69, a little above 69%. And right now, we're running at about 64 to 65%, which is about 2/3 of Americans currently own a home. About 1/3 would be renter. And we also look at the sentiment of the realtor who's out there. We still have a high 88% level of consumers using realtors to sell their homes. We mentioned earlier that the asking prices were going up, and this is pretty telling. We see in all three areas, single family, townhouses, and condos, realtors are becoming much more optimistic in their local markets and much more confident than they have been over the last 2 years that those properties are going to sell. Specifically, the single family market is getting above that 50% level, which we haven't seen since before the meltdown in 2007. One of the downsides of recovery is the uptick in interest rates, and I had predicted last quarter that we are bottoming out on our rates. Much like housing, it'll take a time for the bottom to form, but I believe that we've hit our low for interest rates for the year, and we may bounce here, but we saw our first print back above that 4% level on a national average basis, and the 10-year Treasury has also been turning up. Now, at the consumer level, your ability to save is a function of your disposable income, and we saw savings rates get up here at some pretty high levels, only to drop back down to 4%, and at one point we were down below 2%. Right now we're holding, and this past period we printed about a 4.2% personal savings rate. We'd like to see that savings rate get back up to here because that has a huge impact on future household formations. Now, the general consensus is that we retire on average 1.5 million home units per year. These are houses that are torn down, they're condemned, they just no longer are functional. Someone coming in and making a major modification or improvement. These have to be built just to maintain our current demand. So you can see what happens. We started getting below that level in 2007. We hit a floor in 2009, and there's been a slow struggle to improve. We expect in 2012 that growth to continue. Much of that has to do with that inventory shortfall that we've talked about of when you stop replacing the 1.5 million units a year that are being displaced or retired, that starts to put an additional pressure on the inventory as well. We've seen a bigger startup on multifamily, and then single family is starting to also pick up the pace and should start to get moving again really in 2013. New home starts is another consideration, and you'll notice here there's single family starts in red and you've got your new home starts in blue. Many new home starts actually are never sold, so a new home sale is when a contract is taken out for a property and that property is resold. So if someone goes out and buys a piece of land and builds their own house, that's considered a start, but it never becomes an actual new home sale. So there are different examples, but you'll typically see a gap here, but you'll notice that the single family starts and sales are tracking, and again we see that bottom forming, and based on what's in the pipeline right now, we see an improvement in 2012 and 2013. We talked a lot about inventory, and there's two types of inventory. Visible housing inventory are those units that are listed on the market today. We see that we're in that 2.3 to 2.4 million units on the market today existing, and we continue to see all-time lows in the new housing inventory that's currently listed for sale today. The shadow inventory has been that piece of the puzzle that many people are unsure about, and that is all of these delinquent homes that are in the foreclosure process that have not hit the market yet. You'll notice our inventory there is up close to 3.3 million units. So if you combine that with the existing home inventory already on the market today, you get up to 5+ million units. That takes us from 6 months where we are today to about 12 months of inventory if all the shadow inventory was put on the market at the same time as the visible inventory. Again, the good news here for homeowners, and this is critical for confidence, is that we start to see new and existing home price sales go up, and the median home price is affected by the average price that's sold. And one of the things that we've seen is the majority of the distressed properties have been the lower income properties selling at a dramatic discount. That has continued to depress the median home price, but even working through that inventory with higher dollar stuff starting to pick up, we see a slight uptick in forecast over the next 2 years for both existing and new home prices. It's another reason you might want to start thinking about buying a home today if you're looking at buying a home in the next couple of years. Kind of look at this annual forecast again. You can see existing home sales going up in 2012, more so in 2013. New home sales dramatically as a percent, as well as housing starts picking up. You can see that existing home price actually in a number as it goes up from 166. So if you're doing a presentation to a client and they want to look at, well, what would it cost me to buy a house in 2 years if it goes down? You could also look at the projections for what the average new house price will look like. We see payroll going up, Fed fund rates staying about the same, but also we see, you notice, a pretty big uptick here in forecast that interest rates will start to move up as the Fed has promised in 2013, getting us closer to a 5% rate. We ended our last month's presentation with the seasonality, when to sell a home. This goes a bit deeper and looks at when the searches, the prices, starts, sales, and inventories. So you can see the best price point for the year is also in that March to May. We mentioned sale in May and go away in stocks, and that may apply to real estate because those who don't sell their property by May, you'll notice in the red line, will end up getting a lower and lower price throughout the year. And a lot of that's based on demand. The searches start out here before people really decide what they want to do. So they're in the search process, that peaks. And then they go out there and they look at either starting a house and buying a house. And that sales process, again, is peaking in May to June. And from there, the searches decline, the starts decline, sales decline, and we also, of course, see without that pressure, that buying pressure, prices decline as well. So that's it for this month. Again, we got a lot of neutrality. Economy's kind of neutral. Jobs tepid, but a little more positive. Savings is neutral. Inventory somewhat neutral. Valuation still negative. We still feel the bottom is forming. It's going to take a little while. It's going to be a bit of a bumpy landing, and then we hope to see things take off from there.